A new month, the 1st of October. First, we're going to talk about critical price points. This is first of all the weekly chart. Then we have the terminus high, the terminus low, which is basically the new week opening gap. Above that, we have resting volume imbalance. And so let's drop into the daily chart. We can see we have the previous day closing price at the settlement price tag toggled on, and we have the previous day low, and then the weekly price points annotated and such. And here immediately we can see that we have this volume imbalance with the quadrants of that. We use that to, should there be any disturbance within that region or not, and how we can frame a trade possibly on that. So then we drop into the 4-hour chart. These price points have been annotated in here. This 4-hour wick, as you can see, it's important because this determines the previous day low. And then we have we trade down to the almost to the tick to terminus low. We leave a small portion open. We take out this low, and then we go down to the hourly chart. We see relative equal lows. That's what my eye was on focusing. And this one possibly then too. If we take out this, then we'll most likely take out this, which was all easy to see. And then in here, this was kind of disturbing because I thought maybe then we could have had a Judas swing up in here, but as you can see, we will not have a entry pattern in the 1 hour. In the 1 minute fair value gap, first percent fair value gap. We should have looked at the 15-second chart for that. Then we take this wick, the hourly chart, we frame a trade on that. We could also have taken the 4-hour wick, which then we would not like to see different price points. In this case, we trade up to the lower quadrant of the 4-hour wick and not even make an attempt to enter the 1 hour fair value gap in here. Why is this important? Because we have two immediate rebalances. We trade down to the previous day low, and once we trade back up, we do that to immediate rebalance, which then is an indication that we are most likely to draw down to the terminus. Once we trade down to the terminus, we have an immediate rebalance again, which is most likely that we will trade down again. In this case, we do that to the consequent encouragement, and we almost trade down to the low of that terminus. Apologize for that. This is the 1 minute chart. We see a SMT in the pre-market. We see relative equal highs in here. That's why I wanted to see, could have wanted to see at 9:30 opening, take out these lows. And then we have this is the immediate rebalance. We fill in this gap in here. We don't trade to the upper part of that. We want to see this as a breakaway gap because this is the 1 hour wick and we don't want to trade up into that to see lower prices. Then we have the entry model. This is the Asia session. There we have the new day opening gap. We have the buy side in here. We annotate that. We could have annotated the 6 and the 7 once it takes out the 7. But that was somebody who taught me that, who isn't ICT, so that's a mistake. I muted that motherfucker, so now I'll never make that mistake again. I keep saying that, but I'll never ever making that mistake again. I muted everybody that's on my For You page or my YouTube page. It's trying to influence me. It's devil's work, you know what I mean? So this is the relative equal lows in here. In here we draw up, we draw down. So people who went long in here, they throw their stop loss in here. So now we went up again. We don't take out this high, which is key information. Then we drop down. We take out this low. We drop down again. We take out these relative equal lows. We could have taken this out, but we don't want it. We don't see that. So we trade up back in here. And here we have a volume imbalance. So once price trades back in that volume imbalance, we trade up. Take out this minor buy side, and then take the main target buy side liquidity in here. This is also the 25% range of that daily volume imbalance, which is a very high point of resistance in here. We took out these relative equal lows, which now is jagged. This was clean, this was clean, this is clean, this is all clean, and this is now made jagged. We take out this. We show we're not willing to go further to take this even out, and now this is smooth. So now we trade up in here, we draw lower, and we trade up again. So then we have the AM session. This is, it looks crazy, but once again, I'm going to explain everything. Then we have the PM session. It looks a little bit less crazy because this was just, it was easy to trade this. But we don't learn from easy things. This is the SMT that I was talking about, that these are all relative equal highs, where the price could have taken out these relative equal highs first to then trade down. As you can see in here, 9:30, we rallied up, and then another candle rallied up again, and then we spooled down. In here, 9:30 open, just one candle up, and then we went down, and this is the first percentage fair value gap in that. And that first percentage fair value gap is here much higher. So we annotate that the 7 a.m., the 8 a.m., this is the pre-market. I did not see a trade in the pre-market because at 7 a.m. we spooled down. We don't rally up again. I don't see anything that is willing to engineer liquidity. I don't see a entry for me. Maybe on the 15-second chart. But in here, I could see sell side was taken, this was left open, then we have a fair value gap in here, so this could have possibly be a short. This is an order block, once it trades back up in here, this could possibly be a short. And in here I'm not interested anymore. Then we trade up, we trade down, this could possibly be as engineered liquidity to then rally up first and then rally down to take out these relative equal highs in here. These relative equal highs in here, be at 9:30, but it doesn't do that. It rallied down. It takes out this high again. It it engages the buy side, and on ES it didn't, so it rallied down. It engages these sell side levels. Then it rallies up. It leaves relative equal highs in here. Doesn't take out this high, which is key. So now I still am expecting to take out this engineered buy side liquidity. But price showed me that it definitely did not want to do that because we take out here the relative equal highs in here, which apparently was enough. and then we trade inside the bearish breaker or the Reaper block. The breaker would be if we draw down in here, and then we draw up, and then we draw down. But we trade above the breaker again, we trade lower than the breaker again. So essentially this becomes a mitigation block in here, and probably on the 15-second chart, the last up close candle, we draw that out in time. On the 50-second chart, we draw up into that and then draw lower. But I don't have the 50-second chart, so I cannot have that hypothesis. Is this price delivery? Yeah, okay. Then we have this is the pre-market. We drop down, obviously. We see we don't have any form of entry in here. Then we annotate this. These levels are the hourly wick. We want to see the hourly wick go, and we see this as a breakaway gap. We don't want to trade back up into that because it's the upper quadrant of that hourly fair value gap. Once we trade down to the midpoint of that, preferably we do not want to see that trade above the midpoint of that. As you can see, the bodies are closely, very perfectly respecting that. Then the last up close candle, once it trades back up into that, we definitely take a short. Then in here at what was it? Some 50-minute candle, then you have another 50-minute candle, and then the 50-minute candle after that, the 10 a.m. candle, which is you have the ISM manufacturing PMI and two other news folders, which then closes in this gap, this small portion that was left open. We close in that, we trade up in the order block, we short, and as you can see, we respect the previous day low with the bodies. Then we trade down. We have a immediate rebalance again. This was yesterday. Okay, no. This was yesterday, so keep in mind we are here now. I'm going to explain all this price action into the entry model. This one. So we have the consequent encouragement of that, which I just annotated. And then we do that again with this, which is the consequent encouragement of the other wick. There's another wick. And then the second immediate rebalance. I explained this again. We have a 5-minute fair value gap. We trade up into that. We fill in this gap. We immediately rebalance while doing so. And while doing so, we trade into an order block, which was a very easy trade to see. And now definitely we want to go short. Once we go short, we see that we have a breakaway gap again. If we measure that, then this is the upper part, and then this is somewhere the lower part of that consequent of that wick. And then we don't want to trade above the consequent encouragement of that. So that's why we want to see this as a breakaway gap. Same reasoning for this. At the first macro, price spools down. Once again, we have exactly the same setup in here. We have a 5-minute fair value gap. Once we trade back up into that, we turtle soup that, the 5-minute fair value gap. This 5-minute fair value gap now has meaning. We trade up into an order block where my candle is here. That's a 1-minute order block. The midpoint of that, we short in here. We take out the sell side in here. We take out the buy side in here. This now is the main buy side. And once we trade up, down, this is the main sell side. We trade up, then we trade down. We take out sell side. Now this is the range, the buy side and the sell side of that. We trade up. We see we inverse this fair value gap in here, the 50-minute fair value gap, which is now is key information. And we are at the London close at 11:30 somewhat in here. So once we take out this low, we rally up, we rally down. Once we close above this opening price in here, if we trade back into that high of that, or the opening price of that, we definitely want to take a long entry. In here, price just rallies up. We don't want to see price coming back to that because nobody could see this coming. And that's why they didn't have the opportunity to get in this trade anyway. So that's why there's no reason to stop people out in here because they couldn't get into the trade. right? So once we inverse that, yes, we are above the mid the dealing range of that, but we are still entering in that because this is just an amazing clean setup. We have a fair value gap, 1 minute fair value gap in here. We trade back into the 50-minute inverse fair value gap. We trade a high. We have a partial in here. After that partial, we have a retracement. We go low, we go high, we go lower again with the other high in here. This is too fucking smooth, so we want to take that out. So my stop loss is below the 50-minute fair value gap. We trade up, we take the buy side, and now I want to exit the trade. Once I see this, is that we sweep this, we sweep this, we sweep this. We are with the main buy side. This is still as a breakaway gap, and we are still leaving a part of the terminus open. So that's why we inverse this. We want to go back with the daily bias perspective, and that's when we trade up with the inverse of our value gap, we definitely trade lower. This was also a very easy, it was all easy to see today. It was all just simple. Then the PM session, in here we are in a short trade. We long, we trade this as resistance, we short again. We see we take out this sell side. Everybody that went long in here is now throw the stop loss in here. We take that out. Then we sweep all these lows in here with this wick. We trade up. We trade above the 5-minute value gap. Once it sweeps, we see this inverse of our value gap. We trade up. We don't want price C to come back in that. It can, but preferably not. As you can see, we trade back into the 1-minute fair value gap. At the 5-minute fair value gap, the bodies are respecting that. Also, the bodies are respecting the consequent encouragement of that terminus, which is the weekly buy side imbalance, sell side inefficiency. We trade up, and we trade back into this fair value gap again, and we trade up to go to previous day high. Then we have a seek and destroy in here. We trade to the 50-minute volume imbalance. We have a fair value gap in here. We trade up, we trade up. Once we trade down into that, we do that with speed. So we trade back up into that. We short with just outside the macro, and then we want to take out this in here, which is a part that is, it looks like it wants to be filled up. We don't need to trade to this high because this is a balanced price range. This is now redistributed, and this is now balanced, so we don't need to go back below the terminus. I forgot to mention that in here we could see a spooling of the price to take out these lows. On the ES, I have to say it was a little bit cleaner. It went down with speed, and then it went up, and it was easy to see for me that this was a trade setup that I wanted to play. This all in here, I couldn't really make anything of that because I don't. The 15-second chart is just amazing to see all those things. So when I get my first payout, the first thing I'm going to buy is that 15-second data. So for the people who watched, thank you. For the people who didn't watch and didn't see the value of this, good luck.